The market right now is in an absolute panic. My altcoin portfolio is absolutely bleeding. And I've got to be honest, I've never been more confident that the bull run is coming. Now, that might sound insane, but in this video, I'm going to show you what everyone else is missing. This isn't the end of the bull market. This is a predictable liquidity shakeout kicked off by the TGA rebuild that we've been talking about since summer, accelerated by the Treasury step up in issuance that kicked off in early October, and then even further accelerated and extended by the current government shutdown. And in this video, I'll show you the exact data to prove it. Okay, so recently the TGA, or the Treasury General Account, crossed 1 trillion. And as we've talked about in the past, the TGA is sort of like the government's piggy bank. And I've been talking about the TGA and why it would cause a bearish market environment since this past summer. And basically, I'd spelled out that you should prepare for potentially just weak liquidity conditions and therefore a bearish market in August and September, where we could see just really weak price action in crypto. Now, what I didn't talk about and what I didn't anticipate was what would happen then after in October, which is sort of like this perfect storm of multiple events that have all come together to create this like mythic level weak liquidity in the market that we're currently seeing right now. First off, as I've mentioned in some of my past videos, we had the step up in issuance from the Treasury that happened in early October. This is something that a lot of people missed, myself included, that further kind of exacerbated the weak liquidity environment in the market. But as I had mentioned in those videos, by about mid-October, the global market plumbing should adapt to this extra issuance and it shouldn't be a problem. And therefore, late October, things should flip decisively bullish. At least that was what I had been saying up until this point. And the reason that I anticipated things to flip bullish in late October was a couple different things. For one, we had the rate cut in late October, which is bullish. For two, you had a lot of people that believed in the 4-year cycle who were anticipating a parabolic run up into fall. Basically, the way the 4-year cycle works is we were at the stage where we should see a parabolic run up in the markets. And therefore, you had a lot of people, because of that belief in the 4-year cycle, who I anticipated would come and front run the markets, buying up a ton of alts, buying up a ton of crypto, hoping to front run that parabolic move up. But what we ended up seeing was almost the exact opposite play out, where we had this insane liquidation event in crypto, which in itself was sort of a perfect storm of multiple different events, which I've talked about in past videos. And this just absolutely nuked crypto sentiment, flipping a lot of those 4-year cycle buyers into 4-year cycle sellers. So what was a tailwind to the markets became a headwind to the markets. Now, on top of that, we had this government shutdown, which a lot of people, weren't really concerned about, myself included, because just most of us didn't anticipate that it would last that long. But what has ended up happening is this government shutdown has really dragged on a lot longer than most people anticipated. And because the government shutdown had dragged on for so long, it has started to massively impact the liquidity conditions in the market, which is why I highlighted that the TGA just hit 1 trillion. This is liquidity. This should be pouring out into the market, but instead is getting piled up in the TGA account because you're seeing a lot less government spending due to the shutdown. Now, on top of all of these things, we had the Fed come out in late October and they did cut rates as anticipated. But one thing that Jerome Powell said really spooked the markets and honestly had an exacerbated effect because of the weak liquidity conditions in the market. And that was Jerome Powell's comments on the December rate cut, where he said it's not a certainty. And basically up until this point, the market had been pricing in a December rate cut as certain. Like, we definitely were going to get a rate cut in September. The odds were at like 90% plus. And then Jerome Powell comes in and says, actually, it's not a certainty that we're going to see that rate cut. And because the market liquidity environment has been weak for months and months, sentiment is just in a dumpster. So people are like max fear. We had this crazy liquidation event that flipped all the 4-year cycle buyers into 4-year cycle sellers. This news really had an impact on the markets, where we saw markets just absolutely nuke on these comments. And I actually put in a lot of work compiling all the different data from the government shutdown, the TGA rebuild, the step up in issuance, and everything else for the entire year of 2025 to generate a liquidity score month by month to show you exactly how abysmal conditions have been over the past few months compared to what's normal. And the way this liquidity score works is it's on a scale of 0 to 100. It's accounting for global liquidity, not just US-based liquidity. And 100 is like liquidity to the max, super bullish for the markets. And 0 is like market apocalypse. And you can see in January, the score was around 58, February around 64, March through May, we're sitting in the 50s or the 40s. And then in summer, we started to see the liquidity score tick down, where June was 38, July was 28. And then in August, the liquidity score absolutely dropped off a cliff. And if you remember the first half of August, we actually hit a Bitcoin all-time high. And it was really that second half of August where things really fell off a cliff and just, the whole market really dumped in a pretty horrifying way for those of us who were in the market. And then we saw in September, the liquidity score dropped a little bit lower as the TGA rebuild peaked and as the RRP buffer ran out. And this was supposed to be kind of like the bottom in terms of liquidity. And this is where most people expected by the end of September going into October, things should turn around. But as I mentioned, not a lot of people caught that step up in issuance, myself included, by the Treasury, and almost nobody anticipated how bad the government shutdown would ultimately become going into October. But that's what we saw. We saw the step up in issuance happen in the first 2 weeks of October, which was pretty bad. And then we saw this government shutdown go on week after week after week. And basically, because so much of our economy and so much of the markets are driven by government spending, this had a massive impact on total liquidity, where October, which I had accounted for a few months ago being the second worst month of the year, actually flipped to becoming the single worst month in terms of liquidity by a long shot of the entire year, sitting at a score of 10 versus September's 18. Now, before I show you the scores for November and December, I wanted to show you this chart so you can wrap your head around exactly why the markets are so dependent on government spending. This is the total spending of the first 39 presidents of the US, and this is what the total debt looked like up till about 1972, where you can see it starts peaking up higher. And since 1972, when we got off the gold standard and went full-blown fiat, you can see that the government spending has been unhinged and out of control, and this is the fuel our markets are made up of. This is the greatest Ponzi of all time. And this is why I say all the time, policy is the root cause of all bull markets. Policy decisions dictate everything because government spending has become such a massive portion of what drives liquidity and what drives the market. And when you have basically the government as the one pumping liquidity into the lifeblood of the market and the government stops spending, you get massive turbulence in the market and you get a massive retraction of liquidity, which is what we're going through right now. We are in a debt-driven economy. We are in a debt-driven market. And you have to constantly pump more and more liquidity into the system to keep this thing going, or you have the entire Ponzi collapse and unravel, which obviously nobody wants to see that happen. And basically, because we have these massive levels of debt, the government is constantly caught in these cycles where they're either entering an easing phase of the economy or they're entering a tightening phase of the economy. And every time they decide to enter an easing phase of the economy, things get too out of control. Everything looks like it's going to break because everything's heating up too hot. So then they have to tighten, and then things go the opposite direction, and then they start to break in the opposite ways. And then the government freaks out again, so they start to ease. And they just kind of do this cycle over and over and over again because they have to. Because if they don't, the entire Ponzi falls apart. And if the entire Ponzi falls apart, it would make the Great Depression look like summer at the Hamptons. It would just be absolutely catastrophic. And I highlight this all the time. A lot of the growth that we've seen in crypto has come from institutional flows. It's been specifically one new faucet that's turned on directly to the crypto space. And with the crypto space being so small, I mean, there are multiple stocks that are valued higher than the entire total market cap of crypto. With it being so small, new flows from boomer retail and institutions have a massive impact on the total market cap of crypto, specifically the price of Bitcoin. And a lot of the growth that's been in the stock market, the S&P 500, has been driven primarily from AI build-out. It's come from one specific thing. If you look at the wider economy, it's not the same rosy picture. So we've been in a tightening cycle, but we're about to head into an easing cycle. And this isn't even like guesswork. This is obvious. Trump investment stay all day long. The Fed has started the rate cutting cycle, and we're about to get the end of QT. So during that last Fed meeting, one of the things Jerome Powell signaled is that they're ending QT starting in December. And in terms of liquidity, the impact of ending QT isn't massive because QT was already at like pretty reduced levels as it is. But it does have a pretty significant effect when it comes to market plumbing. Which is one of the big issues in key areas right now that's holding back the markets. And alongside that, what the Fed ended up saying is that they're going to roll over MBS payments into buying Treasury bonds. Now, a lot of people are saying this is QE or stealth QE, and they're getting people really pumped up. That's actually not accurate. This would be a lot smaller in terms of scale. So like the net impact on like the markets and liquidity is going to be a lot smaller from this MBS rollover into buying bills. If you take the kind of like aggregate effect of like ending QT plus MBS, it's not zero. It's like definitely somewhat of an impact, and it's definitely liquidity positive. The MBS rollover is a form of money printing, but it's nothing crazy. So it definitely does add a nice little tailwind to the markets. But as I mentioned, the real impact is in market plumbing, which currently, there is a decent amount of liquidity. It's just being held back by that market plumbing. And this helps smooth things over in terms of market plumbing, which is a really good thing. And so going back to the scores, again, October was abysmal, sitting at 10. This is like apocalyptic levels. Like 1 through 10 is just, you don't want to be anywhere near these numbers in terms of liquidity. And we can see in November, we actually popped back up to around 55. Now, this is hugely dependent on the government shutdown. If the government shutdown goes through November will also be abysmal, and you can expect much lower prices. The government shutdown is a key driver of liquidity, and if we don't see that reversed, it's really bad. But as long as we see the shutdown ended, November should look really, really good, and things should start repairing and rebuilding at the moment that shutdown ends. Because basically the tap gets turned back on, the liquidity starts flowing again, and there are all sorts of back payments and things that are going to get distributed once the government shutdown ends. And then if you look at December, it's even more bullish, sitting at around 65. And pricing even further forward, you can expect January to be a little bit better than December, February to be a little bit better than January, and things overall look really smooth going into the spring. And I saw this post and I thought it was interesting where this guy says, everyone is asking why Bitcoin is not going up while S&P and gold break higher. We had these same conversations in summer of 2020, but most have forgotten and were not around back then. ChatGPT remembers though, and that post says, in summer 2020, many wondered why Bitcoin wasn't moving while the S&P 500 and gold hit new all-time highs. Stocks had fully recovered from the COVID crash and gold surged past 1,000 amid record stimulus and inflation fears. Meanwhile, Bitcoin lingered around 9K to 12K, still below its 2017 peak. Crypto Twitter and investors questioned if Bitcoin had lost its momentum or missed its macro moment. Ironically, that doubt marked the final accumulation phase before Bitcoin broke out in late 2020, smashing 20K and launching the next major bull run. Doubt often comes right before the breakout. 2026 will be the first 5-year cycle. At this point, it is obvious what is coming next. I am not selling. I have not sold out of any of my positions. I'm only looking to buy and accumulate more on these dips. And I'm going to have an update on my 10K to 1 million portfolio soon. I still think the best is yet to come, and I'm putting my money where my mouth is. I have my entire net worth, every dime that I have, I even sold my house, invested into the market. So if I'm wrong, I will lose bigger than just about anyone else out there. I cannot afford to be wrong, which is why I do an insane amount of research. And I'm telling you, we are just getting started. This is liquidity-driven market weakness, and the best is yet to come. And if you're curious about seeing my entire portfolio, or you want to see every time I buy and sell various tokens, as well as different weekly video market updates, currently the Obsidian Council is closed to new members, but you can sign up for the waitlist in the description of this video. As always, none of this is investment advice. None of this is me telling you to do anything with your money. I'm obviously not your financial advisor, and you should always do your own research. If this video is helpful, make sure to hit that like button. And if you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.